Millions of Americans who rely on Social Security are waking up to a very different picture in 2026. New numbers, new rules, new limits. And whether you're already collecting benefits, planning your retirement, or supporting a family member on a fixed income, what's changing this year could have a real and lasting impact on your monthly finances. Some of these changes mean more money coming in. Others include updated rules that, if you're not aware of them, could affect how much you receive or when. Today on Gray Policy, we're walking through all 6 of the biggest Social Security changes happening in 2026. We're going to break each one down clearly, explain exactly what it means for real people, and give you the context you need to feel confident, not confused. No hype, no speculation, no misleading headlines, just clear, honest information, the way it should always be. Let's get into it. We'll start with the change that affects the largest number of beneficiaries, the 2026 Cost of Living Adjustment, more commonly known as the COLA. For 2026, the Social Security COLA is 2.5%. Now, before we go any further, let's talk about what that actually means, because the term COLA gets thrown around a lot, and it's worth understanding how it works. Every year, the Social Security Administration adjusts benefit payments to help keep pace with inflation. That adjustment is based on changes in the Consumer Price Index for urban wage, earners and clerical workers, a measurement tracked by the Bureau of Labor Statistics. When the cost of everyday goods rises, Social Security benefits are supposed to rise alongside them. That's the intention. That's the purpose. And for 2026, that adjustment lands at 2.5%. So what does that look like in real dollars? If you're the average retired worker, someone collecting around $2,015 a month in 2025, your benefit is expected to increase to approximately $2,065 per month in 2026. That's a difference of roughly $50 a month, or about $600 over the course of a full year. For SSI recipients, those receiving supplemental security income, the new maximum individual payment rises to $943 per month in 2026, up from $914 in 2025. And here's something important to know about SSI timing specifically. Because January 1st is a federal holiday, some SSI recipients will see their January payment arrive on December 31st, 2025. That is not a bonus. It is not an extra check. It's simply the calendar shifting the payment forward by one day. Every year, this causes some confusion, so it's worth knowing in advance. Now, for many retirees, $50 additional a month is genuinely meaningful. It helps with the prescription. It covers part of a utility bill. For households on tight fixed incomes, that's not a small thing. But here's what many seniors are already noticing. The costs that are rising the fastest, housing, health insurance premiums, long-term care expenses, aren't always captured accurately in the inflation measurements that drive the COLA formula. So while a 2.5% increase follows the official calculation, plenty of retirees find that their real-world expenses are climbing faster. That's not a criticism of the program. It's simply an honest look at the reality many families are living with right now. And speaking of reality, if you're one of the millions of Americans who's still working while collecting Social Security benefits, the next change is one you really need to understand. More Americans than ever before are working into their 60s and 70s, some by choice, some by necessity. And if you're collecting Social Security before reaching your full retirement age while also earning income from work, the Social Security Administration has specific rules that can affect your monthly payments. These are called the retirement earnings limits, and they increased again in 2026. Here's how they work. If you claim Social Security benefits before reaching your full retirement age, and you're still earning money from a job, the SSA may temporarily reduce your benefits if your earnings exceed a certain threshold. For 2026, that threshold is $24,480 per year for most workers who haven't yet reached full retirement age. That comes out to roughly $2,040 per month. If your earnings go above that limit, Social Security will withhold $1 for every $2 earned above the threshold. Now, let's use a real-world example to make this concrete. Say you're 64 years old, you've already claimed Social Security, and you're earning $30,000 this year at a part-time job. That puts you about $5,500 above the 2026 limit. In that situation, Social Security would temporarily withhold approximately $2,750 from your annual benefits, spread out across your monthly payments. That sounds significant, and it is. But here's the part that often gets lost in these conversations. This is not permanent. Once you reach your full retirement age, the Social Security Administration recalculates your benefit amount. The months during which benefits were withheld are credited back to you, and your monthly payment is adjusted upward to reflect that. The money isn't gone. The timeline just shifts. Now, for workers who are in the year they reach full retirement age, the rules are slightly different. The earnings limit jumps significantly. to $62,160 for 2026. And in that scenario, only $1 is withheld for every 3 earned above the limit, rather than 1 for 2. Once you've officially reached full retirement age, which we'll talk more about in the final segment, these earnings limits go away entirely. You can earn any amount without it affecting your Social Security payment at all. What this means practically, if you're approaching retirement and still working, the timing of when you claim benefits relative to your earnings could matter quite a bit. It's not a simple one-size-fits-all answer, and we'll come back to that theme throughout today's video. But first, let's talk about a change that affects a different part of the population. Workers who are still paying into the system. Every working American who earns a paycheck sees a Social Security payroll tax withheld from their wages. That tax funds the benefits paid out to retirees, disabled workers, and survivors across the country. But there's a cap on how much of your income is subject to that tax. It's called the taxable wage maximum, and in 2026 it increased again. For 2026, the Social Security taxable maximum is $184,500. That's up from $176,100 in 2025, an increase of roughly $8,400. What this means in practical terms: workers who earn income above that threshold will pay Social Security taxes on a larger portion of their wages in 2026. Once your earnings for the year cross that ceiling, you stop paying Social Security payroll tax on anything above it. For most Americans, the vast majority of workers, this change doesn't apply directly. It primarily affects higher income earners. But it's still worth understanding for a couple of reasons. First, because the taxable maximum is directly tied to how much someone can eventually receive in Social Security retirement benefits. Workers who pay into the system on higher earnings over their careers can qualify for higher monthly payments when they retire. Second, because this is one of the primary mechanisms by which the Social Security program is funded. Raising the taxable ceiling brings in additional revenue. This adjustment happens almost every year. It's tied to national wage growth, so when wages rise across the economy, the cap tends to rise alongside them. It's not dramatic, it's not controversial. It's a routine update, but understanding it helps you see the full picture of how this program works. And now, let's turn to a group of beneficiaries who often don't get enough attention in these conversations. The seniors and disabled Americans living on SSI. Supplemental Security Income, SSI, is a separate program from regular Social Security retirement benefits. It's designed specifically for people with very limited income and resources, low-income seniors, adults with disabilities, and children with certain conditions. And in 2026, SSI maximum payments are higher. The new federal maximum for an individual recipient is $943 per month. For couples where both partners receive SSI, the maximum rises to $1,415 per month. These amounts represent the federal baseline. Some states add a supplemental payment on top of the federal SSI payment, so the total amount varies depending on where you live. Now, $943 a month. Let's be honest about what that number represents. For millions of Americans, SSI is the primary source of income. And while the increase is real and welcomed, the reality of living on fixed SSI income, particularly in areas with high housing costs, remains incredibly difficult. Many advocates and researchers have noted for years that SSI payment levels have not kept pace with actual living costs, particularly in larger cities. That's not speculation. That's a documented challenge, and it's one that families navigating SSI benefits navigate every single month. There's also an important timing note for 2026 that we mentioned briefly earlier, but it's worth repeating because it genuinely causes confusion every year. Because January 1st is a federal holiday, SSI payments that would normally arrive on January 1st will instead be deposited or mailed on December 31st, 2025. If you receive SSI and you see an unexpected deposit at the very end of December, that's why it is your January payment arriving one day early. It is not an additional benefit. It is not a special program. It's simply the calendar. Knowing this ahead of time helps avoid confusion, avoids the worry that something went wrong, and helps you plan your household budget accurately for those 2 weeks at the turn of the year. And with that cleared up, let's shift to another group of beneficiaries who deserve a closer look this year. Those living with disabilities who receive SSDI. Social Security Disability Insurance, SSDI, provides monthly income to workers who have a qualifying disability that prevents them from engaging in substantial work activity. It's a program many Americans depend on entirely. But one of the most misunderstood aspects of SSDI is this: receiving disability benefits does not automatically mean you can never work at all. The Social Security Administration has specific rules that allow SSDI recipients to test their ability to work, earn some income, and explore returning to employment without immediately losing their benefits. In 2026, those thresholds have been updated. The key concept here is called substantial gainful activity, or SGA. This is the earnings level at which the SSA considers someone to be performing substantial work. If an SSDI recipient consistently earns above the SGA threshold, the SSA may determine they are no longer disabled under program rules. For 2026, the SGA limit for non-blind individuals is $1,580 per month. For individuals who are blind, the threshold is higher, $2,650 per month. Both of those numbers are up from their 2025 levels. There's also an important feature called the trial work period. This allows SDI recipients to test their ability to return to work for up to 9 months over a rolling 5-year period, without losing benefits during that testing phase. In 2026, a month counts as a trial work period month if earnings reach $1,110 or more. Why does this matter? Because many people on SSDI want to work. They want to contribute. They want the structure, the purpose, and the additional income that employment provides. But they also live with the very real fear that trying to return to work, even part-time, could cost them their benefits and their healthcare coverage. The trial work period is specifically designed to reduce that fear. It gives people a protected window to try, without the risk of immediate benefit loss. If you or someone you love is on SSDI and curious about what returning to work might look like, the Social Security Administration's website has detailed guidance on how these rules work in practice. And consulting with a benefits counselor can make a real difference in navigating those decisions confidently. These rules have real human weight to them. They're not just numbers on a policy document, they represent the difference between someone staying home and someone having the chance to rebuild. Now, we've covered 5 of the 6 major changes. And the final one is the topic that generates more questions, more confusion, and more anxiety than almost any other: retirement age and when to claim. Every year, millions of Americans approach the decision of when to claim Social Security, and millions of them do so without fully understanding how that decision permanently affects their monthly benefit. We want to change that. Let's start with something foundational. Full retirement age, often abbreviated as FRA, is the age at which you're entitled to receive your full Social Security retirement benefit, not a reduced version, not an enhanced version. Your full benefit, as calculated by your earnings history. For most people reaching retirement age in 2026, full retirement age is 67. If you were born between 1943 and 1954, your FRA is 66. If you were born between 1955 and 1960, it rises gradually, 66 in 2 months, 66 in 4 months, and so on until it reaches 67 for anyone born in 1960 or later. That's the baseline. Here's where the decision gets important. You can claim Social Security retirement benefits as early as age 62. But claiming early comes with a permanent reduction in your monthly payment. The exact amount depends on how many months before your full retirement age you claim. The reduction can be as much as 30% compared to your full benefit, and that reduced amount stays with you for life. On the other end of the spectrum, if you delay claiming beyond your full retirement age, your benefit grows. Social Security adds what are called delayed retirement credits, roughly 8% per year for each year you wait past your FRA, up until age 70. So the difference between claiming at 62 versus waiting until 70 can be very substantial. We're talking about potentially hundreds of dollars more per month, for life. What that means, someone who claims at 62 with a full benefit of $2,000 per month might receive around $1,400 instead. Someone who waits until 70 might receive closer to $2,600 or more, depending on their specific record. Now, here's the part of this conversation that sometimes gets oversimplified. There is no universally correct answer about when to claim. The decision depends on your health, your life expectancy, your other sources of retirement income, whether you have a spouse whose benefits may be affected, your housing situation, your plans for work, and your personal financial needs. For someone in excellent health who expects to live into their mid-80s or beyond, waiting to claim often makes sense mathematically. For someone with serious health challenges or someone who genuinely needs the income now, claiming earlier may be the right choice, even with the reduced amount. These are deeply personal decisions. And no one, not us, not any financial content creator, can tell you what's right for your specific situation. What we can do is make sure you understand the trade-offs clearly, so that when you make the decision, you're making it with full information. One more thing worth noting here: if you're married, divorced after a long marriage, or widowed, the rules around spousal benefits, divorced spouse benefits, and survivor benefits add additional layers of strategy and complexity. Those topics deserve their own full discussion, and we'll be covering them in upcoming videos. But at the foundation of all of it is this: the age at which you claim Social Security is one of the most consequential financial decisions many Americans will ever make. It deserves careful thought, accurate information, And when possible, a conversation with a Social Security representative or a financial planner who specializes in retirement. That's not alarmist. That's just honest. So let's bring all 6 of today's changes together, clearly and simply. Number 1. The 2026 COLA is 2.5%. The average retired worker sees roughly $50 more per month. It's a meaningful increase for many, even as some costs continue to rise faster than the adjustment reflects. Number 2. The retirement earnings limits increased for working retirees. If you're under full retirement age and earning income, the new threshold is $24,480 per year. Exceeding it can temporarily reduce benefits, but those benefits are recalculated and credited back once you reach full retirement age. Number 3. The Social Security taxable wage maximum rose to $184,500. This affects higher earners primarily and is a routine annual adjustment tied to national wage growth. Number 4. SSI maximum payments increased to $943 per month for individuals and $1,415 for couples. And the January 2026 SSI payment arrives December 31st due to the holiday. Not an extra payment, just an early one. Number 5. SSDI work thresholds are higher. The SGA limit for non-blind recipients is $1,580 per month. The trial work period threshold is $1,110. These updates give more working room for disabled Americans exploring a return to employment. Number 6. Full retirement age rules remain important and often misunderstood. Claiming early means a permanent reduction. Waiting means a permanent increase. The right answer depends entirely on your personal circumstances, and that's a decision worth making carefully. For millions of retirees, disabled Americans, and families living on fixed incomes, these aren't abstract policy numbers. They're rent, they're groceries. They're the prescription that gets filled or the one that gets delayed. Social Security touches more American lives than almost any other government program. And yet it's also one of the least understood, particularly when it comes to the annual updates that can shift what people receive and when. That's why we're here. The most important thing you can do is stay informed directly from reliable sources. The Social Security Administration's official website at ssa.gov is the most accurate, up-to-date place to check your own benefit estimates, review your earnings record, and understand how specific rules apply to your situation. If you have questions about your individual case, speaking with an SSA representative is always a solid step. And if you want to stay current on Social Security updates, Medicare changes, retirement planning basics, and government programs that affect seniors and fixed-income families, this channel exists for exactly that purpose. Gray Policy is here to cut through the noise, to give you clear, calm, honest information, without the hype, without the fear-mongering, and without the misleading headlines. If today's breakdown was helpful, we'd love to have you around for the next one. There's a lot more to cover, and we're just getting started. Thank you for watching. Take care of yourselves out there.